Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for December 13th, 2022. It is a Tuesday here. Tomorrow is an FOMC Wednesday, so look out for a rate decision tomorrow. That's going to cause some volatility in the stock market. I think it's going to be a pivot point based off of the CPI trade we saw today. I think it might be a pivot type of point or inflection type of point for the Fed and some of the rate decisions we might be expecting. But before we begin here, remember trading futures involves risk. It is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you do want to get in contact with me or join me for my weekly Strategy of the Week webinar every Wednesday or Thursday, at 1:30 p.m., you can sign up to join me in that webinar or join the email thread to get the video of that recording to you if you can't attend the live webinar every week as well. You can also join us for our daily newsletter from Zaner Ag Hedge. Sign up links in the comment section, information section of this video. Without further ado, though, that pivot point in the Fed tomorrow, with the Fed maybe going more towards a laxed monetary policy. We are expecting 3/4 of a basis of a point, rate hikes there for the last several meetings. Now we're down to Fed expectations. I'm seeing in the Fed fund rate here expectations of 1/2 of a point increase. That's kind of to walk back. We're going back to maybe we've peaked now in terms of the Fed's velocity of rate hiking, and certainly with the CPI data showing, which by the way is very lagging. It's that consumer price index is the end spectrum of price inflation, right, that we can gauge. The Fed doesn't doctrine that number, but they pick the basket, right, strategically to tell a narrative they want. That's why we can't really gauge that as just, entire, as an entirety or inflation gauge of all inflation, right? But it is the consumer inflation. So there's producer inflation that happens before the consumer gets there, and then there's real commodity inflation that happens at the core. And that's what I, would like to turn our focus here today. We see the White House and the Fed and everybody doing victory laps on beating inflation down. Yay, we got a Fed meeting tomorrow, which we'll probably hear Powell talk about that. Hopefully, we'll be looking to the rhetoric and, of course, looking for the Fed to be really, really, I think, strong in that rhetoric towards inflation. If not, we could see a continuation higher. And certainly if we don't completely walk back on today's gains, certainly in risk appetite on markets like the S&P 500, we are far off of the highs. But we are also, continuing an uptrend, and volatility is just very fast. So in the near term, though, I think one market that I don't want to be, fall too far in the back burner is the dollar index. I want to comment here. The dollar has kind of entrenched itself in a bit of a downtrend. My only concern here is that we are pulling back into major levels of potential support for the dollar, that old breakout high, the high end of the range for the last, the prior decade, right? Around the, everything above 100 was only for a moment. Now we're coming down to test that 103 to 100 area. We are below, however, the 18-day, 100-day, and 55-day moving averages, with the 18-day now crossing below that 200-day moving average here, and of course below the 200-day moving average. That come in around 105.67. That 55-day and 800-day moving average looking like we're going to be getting a bearish death cross here shortly too. We're a long ways off from seeing a 55 or 100-day moving average cross below that 200-day, but this is how market tops potentially happen. So if we don't see the dollar index rebound and put a foothold in here at old broken resistance, now support, we might be looking at a period of dollar decline, which is going to be beneficial to our commodity markets, our export markets, I should say, and probably a little inflationary to our commodity prices. So let's take a look at January soybeans, the big winner in the ag space. Well, I guess you could say, or should say, the soy oil was your big winner here today, up 3% on the day in the oil, recovering after a very sharp decline. And what was kind of a meal-driven rally, now we're seeing the oil start to pick up. Oil goes up 3%, and meal only down 0.5% every day. Spread margins or crush margins aren't getting hurt very hard at all. If anything, we're seeing them improve here. And that makes sense, right? So price of soybeans going higher, so we need to see those crush margins also improve, or if the input cost for a crusher is going up, output value needs to go up as well to make sure that the profitable business stays afloat. And the markets, routinely do that. Of course, we squeeze those margins in either way, but we're getting a little more complex than we need to for today's video. The daily chart here, I don't want the nearest, I just want the straight daily, but okay, there we go. Our daily chart here of January soybeans, we've now broken back above all of our moving averages. We did that last week, kind of commented that on last week's video and last week's Strategy Week video. We'll be talking more about that, of course, this week, but we seem entrenched in a little bit of an uptrend here. You can see the upward sloping channel. I don't have it drawn on the chart, but you can imagine a trend line against the lows and against the highs here, creating kind of a channel heading higher. The important thing to note, of course, is that 18-day and the 100-day or 55-100-day moving average crossovers of their respective moving averages. So we're seeing kind of a bullish development, right, in those technicals on the beans. When we look at that March corn, it was getting a little bearish there, but hey, the uptrend we've seen in the last few days is certainly promising. But we seem to be banging into trendline resistance, and that 18-day moving average now as resistance on the corn. And being supportive on the beans is just kind of pits them against each other here. March wheat in the Chicago contract, man, I thought coming into today's morning, I thought we'd get a little higher. I thought we'd get a tested 18-day moving average. We are, below old support here in that $8 to $7.75 area and below the 18-day moving average, but back above those levels could open the door towards 840. I do think that could be on the table here. And with Chicago wheat, the only wheat contract down today, KC wheat here, having actually tested that 18-day moving average at 882, and a half, keeping that protein premium alive there with the KC now at $1.15, for the Chicago contract. Again, if you're going to be a buyer in wheat, still favor buying that KC or Minneapolis contract. If you're going to be a seller, we favor selling the Chicago. And that intercommodity spread there has been trending pretty religiously now for the last several months. Let's take a look at those 4-hour charts. Daily, or I guess the last thing we could comment there is that beans aren't quite overbought yet. Corn is coming off of overbought, sold, and now into overbought territory. So on the daily RSI, so look out there if we are finding resistance there. That could be the short-term case here. Okay, March corn on the 4-hour chart. Open gaps, 589, 736. Some two levels that we just are consolidating between, but we'd like to see us close these gaps at some point in time. I favor kind of us going up, the 736 gap before getting down to the 587, and we have a long time to pick a side for this market to go. We were in an uptrend here coming out of July all the way through October. Then corn kind of turned over, and for the last 2 months we've had a bit of a downtrend, right? And we pulled back in corn into the 640 full 50% long, so that's drawn from 567, 8 up to highs, 711 highs. That 50% pullback in corn and this consolidation lower got a reaction, right? Now we have a multi-day uptrend. However, it's right up into expected trendline resistance and channel resistance. Full 50% shorts off the highs coming around 673. So again, that level kind of aligns with some old resistance here. So love to see us break above 660. I'm interested at being maybe a buyer here on a pullback for March corn, but I don't like in the near term the lower lows and lower highs stair-stepping lower, right? I think that we will probably see a test of 640. There'll be a little bit of a fight over the trend here for a couple of days, maybe into the new year, while we kind of wait for, either, funds to come back and be active, or, really just get into a new calendar year, at the end of the day is really what we're getting it down to. January soybeans seem to be stair-stepping higher. We've traded now from their last swing, 1361 up to the 1469 high. Little three-wave pullback, choppiness into the 50% long into 1415. That area traded up to its negative 23.6% target at 1494. So that's a completed kind of cycle or wave structure higher. I'll remove that from the chart because it's kind of already hit its target. Next in the series from entry low to target high, 50% into the 1450 was expected. Maybe that was it in the 1460. But one thing we are aware of is the breakthrough of this upward sloping or downward sloping trend line against the highs, and a move into 1500, which is of course this kind of old inflection zone. It's the old cluster of highs and resistance we had from the summertime. We're breaking above trend lines. We're testing this area. Maybe a breakout towards that open gap at 1540 is finally going to happen. And if that's going to be the case, now we're talking about threatening a rally towards and into new contract highs. So, okay, it's a, if anything, this is a rocket, I think, with a fuse lit, maybe pointing higher. It's the bulls market to give up. We see positive developments in the meal and the oil that I think are underpinning, the reason we're seeing this rally, or not underpinning, the reason we're seeing this rally. And today's engulfing, candle to the upside is a very stark reversal. This is the type of quick pullback to test broken resistance and support, and a move back, in a showcase of the bullish reaction higher that you get for now follow through higher. Upside targets expect, a move towards 1510 now, and honestly maybe breakthrough towards 1520 to 1540. Momentum swinging higher for the soybeans, and when you look at that on the daily chart, right, we're not really overbought. The market has room to the upside on this daily RSI chart right here. You look here, we're only at set 0.73. We could get, we expect, when the market's getting toppy, us to get to 1.0 or, and then kind of roll over. Well, we got room to the upside is what it says to me. So don't underestimate what the beans can do. We're going into a low liquidity time of the year. We're seeing those exports happen. And, hey, we even saw some flash sales this morning. So if those sales continue to happen, particularly at a time of the year where the futures and other markets are a little liquid, I know we've got pretty good basis prices out there. So maybe Christmas is coming and Santa's about to deliver us a soybean price rally. But with all that being said, I hope you enjoyed today's Strategy of the Day. Do join me every Thursday at 1:30 p.m. for the Strategy of the Week webinar. Again, sign up links in the comment section and information section of this video. Of course, you can always get in touch with me over here at Zaner at 312-277-0110. Find me on Twitter, on Facebook, or shoot me an email at dhussey@zaner.com. I'm Dan Hussey with Zaner Ag Hedge. And until tomorrow and the rest of this week, everybody, have a great day. And I'll be back with you as price action develops. Take care, everyone.